Hi Gerard, welcome back to CountDeFi. With crypto adoption obviously exploding, one of the biggest questions we keep getting is what exactly counts as a taxable event?
Hi Brian, thanks for having me again. And yeah, it's a very important topic. It's something that comes up a lot, and the RS has made it extremely clear. Crypto is treated as property and not a currency. So that essentially means many activities create taxable events, even if you do not touch traditional cash.
Okay, well, let's get a bit more specific. What are some of the most important taxable events crypto investors should really know about?
Sure. So there is a few big ones. So selling crypto for dollars, that's going to be a capital gain or loss. Swapping one coin for another, let's say ETH or SOL, that's a disposal of ETH and the acquisition of SOL. Spending crypto, like buying a laptop with Bitcoin, that's going to be treated as if you sold the BTC first. Earning crypto, so through mining, staking, airdrops, that's taxable income at fair market value when received. Let's say getting paid in crypto, let's say USDC instead of USD, that's ordinary income, so subject to payroll or self-employment tax. And then of course NFT transactions, so minting, selling or trading, that can all have consequences.
That's a lot more taxable activity than I think most people realize. What about just moving coins, between wallets?
So that's a great question, and that's also something that gets asked quite frequently on our calls. So moving crypto between your own wallets, it's not taxable. But, and this is where many people usually slip up, you still need to keep records so your original cost basis does not get lost.
Fair enough. Speaking of records, what exactly should taxpayers then be keeping track of?
So at minimum, I would say the date and time of each transaction, the fair market value in US dollars, your cost basis, proceeds, wallet addresses, and then the type of the transaction, so the nature. Exchange histories and wallet exports are very helpful, but it's very often incomplete. So that's why an audit-ready consolidated report are very, very important.
It's a lot to keep track of. Tell me, where do people often make, let's say, the most mistakes?
So usually a few common ones. People assuming crypto to crypto trades are not taxable. Ignoring small transactions like a few dollars airdrop. The IRS is going to expect you to report those. Relying on those exchange summaries, which may not track the transfers correctly. And then overlooking international reporting requirements like FBAR or FATCA for US taxpayers with offshore accounts.
Okay, that's sounding pretty overwhelming. So when in your opinion does someone call in the professional help?
So if you're using multiple wallets and exchanges, trading NFTs, active in DeFi, or have international exposure, that is usually when it's best time for professionals to step in. So find someone that can produce an audit-ready report tailored to the IRS and the global requirements, so investors can stay compliant without the stress.
Perfectly put. So I guess the bottom line here really is don't assume crypto taxes are simple. Every transaction, I suppose, is the one that matters, and keeping very accurate records is critical. Thanks again for joining us at CountDeFi, Gerard.
It's my pleasure. And remember to what we always say in these videos, good record keeping today saves a lot of headaches tomorrow. So if you have any other questions, please click on the link below to book an obligation-free call to best understand your crypto tax situation.